Greetings. I'll give people a few more seconds to sit down because it's such a big crowd and everybody's so excited. Thanks for that warm welcome from everybody. And you don't have to worry as much about getting sunburned right now, which is good too. And you're in the shade. So, yeah, I'll give people a couple more, whatever, to find their seats. There's plenty of room in front, too. And, yeah, I guess we're all matched up with the slides over there.
Anybody go to the sound bath this morning?
Is this working? Yeah.
Yeah. Huh. We might need tech support for that mic. Is yours working, Ryan?
Yeah, I can just pass it.
Uh-huh.
If you want.
Let's try that.
Okay, great. Good. Test it. What'd you say about the sound bath?
Oh, I said, did anybody go to the sound bath this morning? I heard about it. No. It's cool. If you ever have a chance, definitely do it. Maybe not at 6:30, but I have a fan at Nuveen who has done a sound bath, yeah.
Okay, anyway, just introductions. I'm John Gittlesohn. I'm a commercial real estate reporter for Bloomberg based in LA. So we have a pretty diverse panel here. Devin Chen from PIMCO. PIMCO has $1.8 trillion, including almost $200 billion in real estate that they manage. PIMCO's major fixed income alternative asset firm. Ryan Williams, founder, co-CEO, sole CEO of Cadre, which I'll let you give a good description of what you want to do exactly. And then Jill Jenson, who works with Nuveen, major asset manager. You got what, $156 billion of real estate. And something I learned this morning that we can talk about later, they're like the world's largest investor in farms, commercial farmland. So think about that. Anyway, I have a couple of slides also just to sort of introduce this panel. Yeah, this was a cover story we had earlier this year on Bloomberg Business Week that I co-authored about how commercial real estate is getting very scary. And then next slide, please. I mean, the big change, you can see on this slide that interest rates shot up. And they've been higher before. This one goes back to like 2000. But what took people are used to the bottom part of this curve, and they made a lot of decisions based on that low part of the curve. So what you have right now is what people are calling the sort of great reset. All the math changes when the interest rate changes. Next slide, please. And then this is another indicator. The yellow line there is publicly traded real estate investment trusts and their values and how spiky they've been. The sort of white line is what are known as Odyssey funds. They're basically institutional real estate funds run by big companies. Nuveen has some of them. And you can see that what's happening with prices much more volatile in the public space than in the private space. But we could talk about it. There might be sort of an arbitrage there between the two for people who are interested in investing in real estate, something to think about. And then the last slide here, a couple other things, just sort of key points that we're going to cover today. Higher interest rates, how they change the math. The second thing is not all real estate is created equal. And the third one is like that arbitrage divergence between public and private. And the fourth one, this kind of goes back to the first about interest rates. Is it better right now to be a lender or a borrower? Or how can you, sort of play both of those things? So why don't we start with Devin and just sort of talk about PIMCO and your real estate investing and where you see the market and yeah.
Hey everyone, good morning, good to be here. Thanks, John. Just quick snapshot of the PIMCO real estate business. We manage about $200 billion of real estate assets globally. Roughly 60, 70 billion of that is on the public side, so public securities, mostly CMBS, REIT securities. We're the largest investor in the CMBS market globally. The rest is private assets, roughly 2/3 equity, 1/3 credit. And in our private business, we invest really across the risk-return spectrum from core all the way to opportunistic. And comment on what our view of the market. So, yeah, I mean, I think John's slide with that showing the interest rates really sums up the situation. That interest rate shock has been the biggest contributor to what's going on in the commercial real estate market right now, and it has been a very challenging, call it 18 months. And our view is prices probably are going to remain under pressure for a period of time. Simply put, the cap rates right now are still lower than financing costs, and that's not a sustainable dynamic. So,
And what's a cap rate? Explain.
it's essentially the yield on real estate assets. It's your cash flow divided by your value, and that relationship needs to adjust. It's a bit upside down right now, so we think that's going to take some time. The credit markets are severely congested. We'll probably get into that a bit. I mean, but I'll just say, when you look at the pressure that's building, it's really along the debt side, the wave of loan maturities that are coming. In the next year, it's about $1 trillion of debt maturing in our market in the U.S. alone. And a lot of that debt was put in place in 2021, which was peak market pricing, rock bottom interest rates. That pressure is building, and it will take some time for the market to absorb that. It won't all just be forced selling. We think there's going to be a lot of structured transactions over the next couple of years, but we do think there's going to be continued pressure on the market.
Great. And Ryan, tell us about Cadre and what you do, and yeah.
Yeah, thank you. Good morning, everybody. It's good to be out on the West Coast, get out of New York for a few hours at least. So I'm Ryan Williams. I'm the founder and CEO of Cadre. We are a next-generation real estate investment platform. We invest in the mid-cap real estate investment space, so typically targeting assets between 50 to 200 million of total enterprise value. And what we've done that's really innovative is eliminated the traditional double promote that real estate private equity funds charge, give people access to institutional quality real estate in that niche, and give them access at lower fees, more transparency, and then we've also built secondary market to give people liquidity. We typically work with institutions and individuals, which is one of the unique dimensions to our business. So we work with a ton of family offices, RIAs, endowments, but then we've got 50,000 plus high net worth accredited investors on the platform as well. We manage more than $5 billion of real estate around the country. Most of what we invest in, again, is in the Sun Belt. We typically focus on equity. We've done some pref. And in terms of the opportunity today, we're cautiously optimistic, especially in the niche that we play in. And because there's been about 10x the number of mid-cap transactions as large cap over the last 2 years, but mid-cap dry powder, so uninvested capital is less than 10% of the total dry powder out in the market today. So there's a mismatch in terms of the amount of supply that we think will be stressed in the coming months and quarters, especially in this niche, especially when you think about who lends to these mid-cap managers. These are regional banks oftentimes. A lot of regional banks are under pressure. So we are in the process of finalizing our third fund to capitalize on the dislocations that we think will emerge in multifamily and industrial in this mid-cap space over the next 6 to 9 months. And as I said, we're cautiously optimistic that there's going to be some really compelling opportunities. Right now, it's definitely the calm before the storm.
And if I want to invest through Cadre, what do I have to do to qualify? What kind of funds do you have? Are they locked up? How does that work?
Sure. So minimum thresholds, being an accredited investor. We also have a number of RIAs, dozens of RIAs who invest on behalf of their clients. But everyone has to be accredited ultimately. And you can be qualified through the platform. And once you've actually been qualified, you can build, again, your own custom portfolio, which is one of the unique elements to what we've done, or invest in our diversified fund offering, just like a traditional real estate fund without all the fees and more transparency. And as I mentioned, quarterly liquidity that we hopefully will move to bi-monthly over the next 6 months.
And do you develop? Do you value add? Do you do core investing? What kind of?
Yeah, our bread and butter is really value add early on, and so we've invested $1 billion plus in value add real estate the last 10 years since I started the business. But we've also done some development opportunistically. We launched an Opportunity Zone program in 2017, put about $350 million out in that program. That was all ground up development in Sunbelt primarily. But our bread and butter is value add real estate. And so right now things are a bit quiet, but as I said, I do think there's going to be some really compelling opportunities in our niche given the stress that a lot of these local operators we work with are under.
And Jill, tell us a little bit about Nuveen, your real estate portfolio and offerings.
Sure. So Nuveen's real estate business today, we're the 5th largest global real estate manager in the world with over $155 billion in real estate assets. With a rich history going back 85 years, we employ over 775 people just in our real estate business, with offices in 30 focus markets where we want to own physical properties. Our strategy that we offer through the wealth channel is global, it is multi-sector, and it is core plus real estate. So complement to a value add strategy, really looking to deliver a 7 to 9 net return profile over time, for which 4 to 5% of that would be income, durable tax-advantaged income that comes through the pass-through with a private perpetual REIT. In the current landscape, I think, John, your slide is absolutely right. Not all real estate is the same. Not every office building is under siege. And capital market dislocation has been the issue as a result of rising rates, as opposed to healthy fundamentals in real estate sectors that we like to own, with low vacancies, good rent growth. And we'll talk about some of those sectors that are unique that you may or may not see in other real estate strategies.
And you mentioned tax benefits of real estate. I mean, I can put money in a CD and get 5% or whatever now. And you said a lot of your real estate returns 5%. But what are the benefits? Why should I put money in real estate? And especially because it's kind of locked up.
Mm-hmm. Yeah, I mean, private real estate is a diversifier to a core portfolio, offers a hedge to inflation. It offers durable monthly income. It offers low correlation to public equities and fixed income, incredibly low volatility. Standard deviation in private real estate's about a 3. Real estate depreciation through a private REIT structure can be passed through to investors. So the annualized distribution yield of, call it 5+%, is reduced in the form of return of capital. So we defer ordinary income taxes on those distributions in the year that they're paid in exchange for long-term capital gains down the road. Historically, you might see 60 to 70% return of capital from your annualized distributions. For 2021 and 2022, 100% of our strategy's distributions were return of capital. That is not guaranteed, that is not promised, disclaimer, but there is an advantage there.
And Green Street, they're a real estate analytics firm that's just down the road in Newport Beach. They say overall commercial property prices are down 16% from their peak last year before interest rates went up, and office is down 31%. So Devin, starting with Devin, how far till the bottom? What'll it take to sort of, find a bottom, and when do you start taking advantage? When do you, move in and pounce?
So yeah, some of those values you threw out. One thing about the impact to the market is it's been pretty dispersed. So when you look at commercial real estate, it's a very broad asset class, and the longer duration real estate assets are probably down at the higher end of the range. Shorter duration assets like a hotel that has nightly leases that reset, essentially, those are interestingly down at the lower end of that range. But obviously all the sectors have been affected. I agree with Jill, but it's really not been a fundamental issue outside of office. It's really been more of a capital markets driven dynamic. So I think what we need to see a couple things before we kind of reach bottom and the market can start to recover. Number one, we think rates need to stabilize. So we're getting there. Are we quite there yet? It's unclear. Real estate investors, like the three of us here, we have to essentially underwrite a pretty broad range of outcomes in terms of not just your borrowing costs, but what your exit cap rate is. So number one, we think rates need to stabilize. Number two, there probably has to be some more transaction activity to get transparency around where values are. And eventually we'll get there. I mentioned the wave of loan maturities. That will force some activity. Some of the redemption queues around the Odyssey core fund, some of the non-traded REITs, that may lead to some selling, banks de-risking. So over time, there'll be some more price discovery. I think that needs to take place, but it'll take some time. And then I think the credit markets just need to normalize. And it's a bit circular because I think as rates stabilize, as there's more price discovery, spreads probably start to tighten. We can debate base rates, what happens there, but eventually then the cap rate to funding cost dynamic starts to normalize, and then you start getting back to a more normal market where there's more transaction activity.
Well, to get back to normal, can interest rates just stay where they are, or do they have to go down? Are people holding out for, I don't want to take out a mortgage on a house right now because it'd be 7% or whatever. There's a term in home buying where they used to say, like, marry the house, date the rate, expecting interest rates would go down. Is that in PIMCO's outlook? What's going to happen with interest rates?
Well, our general outlook is that rates probably stay higher for longer. There's a bit of stickiness to the inflation. That's how we're underwriting. But that said, that doesn't necessarily mean rates have to come down for the markets to normalize. Eventually, we're going through a massive reset of our market right now. And I don't want to sound too dreary. I actually agree with Jill and Ryan. This is actually a very, very interesting investment opportunity right now, because essentially what you have right now is a very illiquid market, both on the credit side and the equity side. The credit side, you've got banks that are massively retrenching. It started with the big banks. It sort of gradually transitioned to the regional banks that cover mostly the middle market assets. But it's not just the banks, the non-banks. If you look at the mortgage REITs, you can read their transcripts. They're not originating. They're really focused on preserving liquidity. The securitization market is way down. The CMBS market's probably down 70, 80% this year. So the credit market is as congested as we've seen since the global financial crisis. And then on the equity side of the equation, again, these vehicles that were really the biggest buyers of real estate leading into 2022, the core funds, the non-traded REITs, they are somewhat under pressure right now because of the redemption queues. So the way we look at the market is this is a tremendous opportunity to provide liquidity into a very liquidity-starved market. We're focused on the credit side right now, and we can talk more about that. I don't want to monopolize the time, but we're more focused on the credit side because we do think you can be more of a price maker in this environment, and it gives us a bit of insulation from potential price declines by being more senior in the capital structure.
And Ryan, as a investor, what are you doing right now? Are you waiting? Are you finding opportunities? Are they coming to you, or do you have to go looking? And what are those opportunities? You got any examples?
Sure. We are right now a lot more focused on actively managing our portfolio. We're fortunate we put in interest rate caps on any of our floating rate debt months ago, and staying close to our operators. We're a platform that partners with local operators around the country. We think great operators, like in the equities market, can drive out performance, and our operators are kind of giving us a good sense for what's going on across their holdings. And again, we play in this mid-cap space, so these are relatively, let's say, lower capitalized managers than you were talking about a major institutional fund. And it's clear that over the next 12 to 24 months, there are a lot of folks who don't know how they're going to extend, the loans that they have outstanding, where there's maturities coming due. There's a lot of our operators who are talking to us about things like, can you recapitalize us or one of our partners out of a certain asset at a pretty attractive basis? They may have added some value to a deal and want us to come in and provide effectively a form of rescue equity capital. And I can think of one example that we're looking at in Dallas with a really great local operator we've done multiple deals with, who's come to us and said, we've got a multifamily portfolio. We bought it 3 years ago. It's actually pretty attractive debt, but term is relatively short. Can we come in and sell 50% of the asset to you at a pretty interesting basis and own it long term? It seems like I always get the motorcycles when I'm talking, and extend out. So it's a long-winded way of saying I do think, to Devin's point, this is an amazing opportunity for unconventional, non-traditional capital providers to step in, because many banks are paralyzed. But I also think it's a really great opportunity for equity sources, to really have boots on the ground, work with their local operators to provide recap equity, especially in this niche when, again, banks are paralyzed. So that's what we're focused on.
And one thing you mentioned, interest rate caps on floating rate debt. It's kind of terminology, but basically that's like an insurance policy. And what's happened to the cost of that insurance? That's like a huge, and that's a factor, isn't it?
Yeah, no, it's gone up meaningfully. It changes with the market, but yeah, it's incredibly expensive on a relative basis. We're again fortunate. We paid what we thought was a pretty high price early on to lock in rates 6-9 months ago, but those costs have gone up. The other interesting cost you mentioned, insurance. That's another line item. Just from an OpEx perspective, we've seen skyrocket and really eat into cash flow and margins across our portfolio. So we're looking at, of course, the capital markets, but I'd say the other big area of erosion, which presents opportunity, is yield. And when insurance costs are what they are, rents aren't really moving up. A lot of folks are looking at their deals saying, is this now a negatively operated asset from a leverage standpoint? And that's, again, where I think smart buyers can come in and provide that rescue capital.
And Jill, when we were talking earlier this morning, you mentioned you're starting to see sort of forced selling coming out, that there are people. You mentioned a portfolio of, I thought, industrial property that you guys acquired. Can you talk about that?
Yeah, I would agree in that with Ryan that it's a great time to have liquidity, to step into the market in opportunistic moments and make some timely acquisitions off market at negotiated discounts with attractive going-in cap rates. I think in terms of where we are from a devaluation cycle from peak last September, we've seen declines of about 8%. We have our portfolio independently appraised 4 times a year at minimum, so our marks are pretty timely, and in many cases, some of our properties have actually been marked up. So the rate to which the devaluation process has come down from Q4 of 22, Q1 of 23, we're starting to see that flatten out. So just to circle the comment on Devin's topic about timing, is now a good time to start to think about it. What also has been really attractive is not only our valuation starting to flatten out, but we've offset that with rent growth. And so that income side has been a leveling effect on this capital markets situation. I think in terms of our acquisition strategy and the types of properties we look to acquire, it is on a relative value basis, it is regional, it is situational, it is the right city, the right type of property, the right time. And we were fortunate in October of last year, a larger private fund needed to sell a large asset, an industrial property in Dallas. So we were able to acquire that at a going-in cap rate of about a 5.3. So some attractive opportunities still exist. You just have to kind of know where to find them.
And did they come to you, or did you guys have friends who, I don't know, how'd you even find out about this?
Our sourcing and acquisition teams are scattered around the world in really 30 core markets. The top 2% of global cities that our research staff has identified that have the strongest forward projected population growth, the right mix of demographics, populations of 150,000 or more, we filtered down from 4,000 global cities to about 90. So boots on the ground in Dallas helped us source that acquisition, absolutely.
And Devin, PIMCO, you guys invest directly in real estate, and you also do all kinds of financing stuff. Right now, is there a sort of allocation ratio that you're saying? You were talking earlier about the benefits of credit and being having ability to finance stuff. Can you explain why now might be a good time to be a lender as opposed to a borrower?
Yeah, I mean, I think it sort of goes back to my point earlier that the credit markets are congested. So your traditional sources of funding aren't what they are right now, whether it's the banks, the life cos, the securitization market, maybe the agencies are the only ones that are still functioning normally. So essentially, there's an opportunity as a lender to step in, provide liquidity, get paid, in our view, a very attractive premium for that. It's not just the base rate, it's the spread as well, and still be senior in the capital structure. I'd say for our more opportunistic strategies that we run, we are probably focusing a bit on what Warren was describing, what we call rescue capital in the industry, which is really, what we're doing is trying to fill that gap. A lot of these capital structures need to be reset, again, because they were put in place in 2021. So when values come down, the borrower's not going to be able to refi that existing loan. They're going to have to pay it down. Sometimes they may or may not have liquidity to do that. And in many instances, they still have value in the property. They want to hang on to the property. They're looking for some sort of structured solution to get them through this difficult period. That's an area of the cap stack that we're focused on in our more opportunistic strategies.
And yeah, there's a term I heard called survive till 25. Is that kind of what you guys are trying to help people do, is make it across the next couple years?
Yeah, I mean, I always say to our team, it's not, you can't just approach operators, financial institutions and say, hey, look, we've got $1 billion. Can you sell us your assets on the cheap? You have to really think about the counterparty. What can you do to help them address their issues, be a solution provider for them? So obviously the most immediate need for them is liquidity and to buy time. I think there is a view out there that the rates will eventually come down. That may help cap rates stabilize and essentially allow those owners of real estate to reset their capital structure in a better environment, but they're willing to pay a premium in the meantime to bridge that time to get there.
And Ryan, yeah, what are you seeing as far as people needing to survive till 25, or you needing to survive till 25? What's the strategy?
Yeah, well, we're focused on thriving through 25. So that's I didn't get a chance to answer it, but no. But I do think there is a real, it's a real situation in terms of operators around the U.S. Again, especially in our niche, who rode the wave, and again, eventually, the wave comes down, and I do think that. This is an opportunity to kind of catch that and ride it back out in terms of investing, and that's what we're looking to do with our operators. Agreeing with Devin about providing extensions and allowing these managers to focus on offense versus defense. I started the business largely because when I was investing first go around in 08, 09, I was just surprised at how many non-institutions were able to participate in the recovery to come. And I look at this as, it's not 08, 09, but there's a similar element here of can we as a platform provide, individuals, institutions, the ability to grow with what is to come, because there will be opportunity on the other side of this. So whether it's with our operators or with our investors, we're thinking about how do we provide you either access to capital or opportunities that let you grow, your own financial wealth. And yeah, look, there's folks in the office space who, they're giving keys back. Blackstone's giving keys back. Brookfield's giving keys back. So there's, of course, going to be these episodic sectors and markets that are stressed. But again, there's a lot of opportunity for growth as well, and that's what we're focused on. And I think that's what's critical to letting more people participate, in the appreciation to come.
And Jill, you're based in San Francisco. San Francisco has been hit harder by this cycle. The real estate in San Francisco has been hit harder than just about anywhere else in the country, partly because it went so high and had farther to fall. But what is it like actually on the ground in San Francisco? Are there places where you wouldn't want to touch and places where it's like, man, that if I had a few $1,000,000, I would buy something there now?
Well, this week it's quite busy because Salesforce has their Dreamforce conference in San Francisco. So we have an incredible amount of life source in the city at the moment. But going back to office, not all office buildings are the same. It's regional and situational. So the office sector that is struggling is Class B, old stock, high-rise office buildings in gateway cities. In San Francisco, where we have vacancy rates upwards of 30%. On the other end of that is Singapore, which have the highest occupancy rates in the world today. The Class B office situation will right itself, and probably through a value-add manager who, with a lot of capital and perhaps support of the state government, can repurpose this space for higher and better use in today's time. Nobody wants to go into an old, tired building, endure the long time and cost of a commute to sit in an office with crappy lighting, bad air, asbestos, no cool modern amenities that today's modern worker wants. So what we see on the flip side is buildings built 2015 and newer in densely populated suburban or close to work from home, low-rise office buildings, parking lots are full. For our portfolio, we own exactly 2 office buildings. One in Utah, Silicon Slopes, and one in Atlanta. They're fully occupied, they're unencumbered. We had one tenant move out of our Atlanta property recently. An existing tenant wanted to take that space, and they're paying us 24% higher rent. So it's not all doom and gloom, and in San Francisco, I think when you move around the Bay Area, you see pockets of density, and I've lived in the city for 25 years. I'll always bet on the resilience of the Bay Area, and particularly technology, which has always lifted us out of historical bad times. So stay tuned.
Ryan, you talked about, sort of compared what's going on now to the 2008 global financial crisis. One thing that I covered real estate after that, and out of all the big foreclosure home housing bust, there was a new asset class of single-family rentals that was an institutional way of investing. Is there anything like that that might emerge out of the current cycle, given like oversupply, below replacement value, and a potential use in the future that like institutions with all that dry powder out there might be able to put to work?
Yeah, I actually got my start investing in single-family homes, and that's ultimately what propelled me, to working at Blackstone when we were getting invitation homes off the ground. So I saw that firsthand, the development of that asset class, and then the securitization and how innovative that was. And you've got to be unconventional. You have to be willing to have conviction, in something that others don't see, and in some cases, be the right place at the right time. And so in this environment, what we're focused on is not necessarily a specific sector or product type as like the next single family, but really how do we package certain assets in a customized way to offer something that's unique and differentiated to our investors. So building customized separate managed accounts where maybe we take a fractional sleeve of multifamily deals in the Southeast, and then industrial assets on the West Coast, and packaging those up and offering those at attractive basis and discounts, because more and more advisors and institutions are asking for customization and the ability to have more discretion. And so that's what we're focused on from an innovation perspective. Less so, we think data warehouses or life science or whatever other sector is the topic of the day, retail. And we think staying true to what we've done, but packaging it different is another form of innovation as well that our investors are looking for. And I think you can afford to do that in a time when not everything is up and to the right.
Yeah, go ahead.
Just to add, so one sector that is emerging the last few years is sort of a derivative of the single-family rental market, which is what we call BTR, built to rent, and these are homes that are built single family. They might be detached, they might be attached, but they are built for rent instead of selling. And so that's a segment of the market. It's in its early days. I think if you look at the numbers, like $2.5 billion of build-to-rent assets traded in 2021 and 2022, compared to over $300 billion for your traditional multifamily assets. So it's an asset class that's very much in its infancy, but we actually see a lot of tailwinds for it. We just closed our first build-to-rent investment. We plan to do more, and it doesn't have some of the supply issues that multifamily is dealing with right now. And just in terms of, you think about the millennials, the demographics, they're starting to get to an age where they're forming families. They want to be in bigger homes. They're outgrowing multifamily. So it's a segment of the market that we like. It's a bit more efficient to operate than the traditional scattered single-family rental type of approach. So it's something that I think will grow over time, but still early days.
Yeah, one thing I've also heard a lot of people talking about is data centers as something that artificial intelligence is driving. One guy gave me a line that said, if you ask a question on Google, or if you ask a question on Google Bard, which is their AI, the Google Bard needs 10 times as much computing power to ask it as a normal Google query. And so you basically need a lot more data centers to answer all those questions and provide all that. And that's just sort of like one metric, 10 times the data centers plus everything else that's flowing around, being analyzed. So if you can figure out a way to look at data centers, that's something also interesting. Go ahead.
I agree. I also think that, just piggybacking on some of what Devin said, the opportunity to build, whether it's a programmatic account that focuses on converting, whether it's Class B office assets or just underutilized space into sectors that are interesting in certain markets and geographies. I mean, I think that, conversion development opportunity is unique and is something that it's market specific. It's hyper local. What works out in California is not going to work in New York necessarily. So I do think if you can be flexible, you can get your collective, which is a hurdle in of its own self, the collective government force and will to whether it's partnerships, subsidies, or otherwise support some of these conversions. Like that can be an interesting opportunity coming out of this period of time, because then you can just buy at incredible basis and discounts. But we haven't seen any models, at least to my knowledge, that have shown that that's hyper scalable at this stage.
We, Jill and I were talking earlier about, you had heard that some offices are being converted to like farming, or talk about that a little bit and go way out into.
Yeah. Well, I mean, I think long term, these vacant high-rise buildings will get repurposed, very likely for housing, which is what we need, particularly in California. Near term, though, you've seen subleasing activity pick up, and we've heard in certain instances some space has been used for indoor farming. For example, John and I were talking about the recent legalization of mushrooms for psychological benefits. I can't speak to that if that's what's growing inside some vacant office space.
But they grow in the dark, so you don't.
They could. You
There's
just turn the
definitely
lights
demand,
off.
so
Yeah, but just like the tired shopping malls of the 80s that are now senior living centers or pickleball courts, all of these assets have a higher and better use, as we go along. So I would just echo Devin's comment about housing, particularly single family. We've been in that space for some time. We like that opportunity, particularly for the elder millennial statesmen who are now in their 40s, married, maybe with 1 or 2 children, and need more space. In a lot of cases, they're working from home permanently. As Devin said, we partner with an operator that builds single-family homes for rent in master plan communities. So we're not coming into your residential neighborhood and plucking off every single-family home in your market and taking that supply out of the market. But relative to multifamily, where we've really hit the pause, we have not made a new multifamily investment in the United States since the end of 2021. With all of the Zoom zone pandemic relocations to the Sun Belt and the South, it has put a lot of supply pressure on some of those markets and has created some pricing pressures as well. We are constructive long-term on multifamily. It's about 19% of our portfolio, but we will opportunistically probably step back into that market when the supplies start to normalize.
We got a little less than 10 minutes. Does anybody from the audience have any questions? Anybody? Can you repeat it? I didn't hear.
Public REITs versus private REITs?
Okay, yeah.
Public real estate?
Yeah. Any thoughts on that, Devin? Since you guys do a lot of liquid securities, yeah.
Yeah, you sort of have to look at it by sector, but generally speaking, public REITs do trade at a discount to private asset values. It's candidly one of the reasons we think private values probably still has a way to go before the market can normalize. It's hard to generalize. There are certain sectors that actually trade at a premium, but generally speaking, they are trading at a discount. Look, REITs, we will look at REITs obviously in our portfolio. The issue with REITs is you are buying, you could really like your basis, but you're buying securities and relatively passive. So you have liquidity, but you have some volatility that comes with that. And ultimately, you have to ask yourself, is there a catalyst that would close the gap in value between where the stock's trading and where you think net asset value is? And sometimes the stock trades at a discount for a reason. It's never going to get to NAV. But there are instances where, we did buy some multifamily, single-family rental REITs earlier this year, and we just felt like they were fundamentally trading too low. Implied cap rates were well north of 6%. Even in our more draconian scenarios, we really don't think rental housing will trade in the sixes. So that's the second market where we felt like, okay, that is cheap, and the market will eventually adjust. But it's really case by case, sector by sector.
Yeah, in the blue T-shirt. That seems like a good question for Ryan. He asked about fees and what are you getting, what are you paying for, how much is a rational amount?
Yeah, it's a great question, and it's really at the heart of why I started Cadre. I thought the fees that institutional real estate managers charge were excessive, and I couldn't rationalize it being at that time, if not one of the largest owners of private real estate in the world, Blackstone. And so I think the problem is that there is this double promote, so it's unique to real estate private equity, 2 and 20 like fee at the private equity manager level, and then partner with local operators, they oftentimes charge promote as well. So you can see a 20% gross whittle down to 11, 12 pretty quickly. And I saw that every day when I was underwriting. So what we've done is focused on still delivering institutional quality real estate, but we've eliminated the second promote. We share in the promote with our operators. So there's only one layer of fees, anywhere from 30 to 40% lower on an apples-to-apples basis to other value-add funds. And we're still aligned with the upside, but we're not charging additional incentive or performance fees. We do charge an asset management fee, but there's only one single layer. And I think that a lot of investors, even some the endowments and foundations that have invested with us, they don't always read the fine print. And the fine print, if you really look at the net IRRs, will tell you that there's a number of layers and intermediaries that are taking their cut of and pound of flesh. And I think that has to change, especially in an environment where returns are compressing. So that's what we've been able to do, and it gives us lower cost of capital advantage as well, because not all 15% IRRs are created equally.
I would just add, and it depends on the type of structure that you're looking at when you talk about the fees, but in private perpetual REITs, there is a standard fee structure that is a management fee and a performance fee. Our strategy is the only private REIT that does not charge the performance fee. So we're a cheap date, but high quality. Fees are always an issue in the absence of value. And we love charging performance fees and sharing in the success with our allocators, and we do. But with a strategy like a private perpetual REIT that offers monthly liquidity, our team didn't feel like that was an appropriate structure to include a performance fee. And it has some knock-on effects to how we run the portfolio. We don't have to lever up the strategy as much because we're not reaching for that excess return net of our performance fee. But it's a good question. Yeah.
Yeah, anybody? Yeah. I'm sorry, I can't hear you.
Insurance costs, he said. Talk why those are increasing. Yeah, I mean, we've seen it really across everything, especially multifamily, whether it's driven based off of insurers' concerns about climate issues and flooding, or frankly just the premiums that they need to charge to support their underlying model and risk, or wildfires and the like. And so it's an issue that you've got to underwrite now. And I think next to debt, it's the biggest form of erosion of yield. So it's also an opportunity, right? Because you can go to a lot of operators who didn't underwrite the kind of increases that you see on insurance, and to give them an exit. But I think it's pretty universal. And I don't actually see a path to, short of some other platform coming out, to it coming down meaningfully. I think it's maybe the new normal.
There's also a pass-through where triple net lease for our non-residential properties, whether it's light industrials or healthcare, medical office, those insurance costs are passed through. So it's really only in residential where you have that effect.
One thing that during the pandemic, everybody was like, get out of California, move to the cheap states of the Sun Belt, or move to the South, Florida. Is the difference still there? Are there financial benefits, or is it kind of equalizing? Devin?
Okay. Well, I think some numbers just came out. Out of the 15 fastest growing cities in America, 12 of them are in the Sun Belt. So we don't see that population trend reversing anytime soon. But at the same time, of those 12, 11 of those markets are seeing the record-setting supply of housing units come to market. So yes, we still like the longer-term trends for the Sun Belt markets, but those markets are going to go through a little bit of a hiccup here, where they have to, as much demand as there is, it takes time to absorb all this housing. And you've kind of already seen it play out in the public markets. If you just look at just using apartments as a proxy, the apartment REITs, the REITs that are more focused on the coastal markets, they've outperformed the Sun Belt focused REITs by, I think, about 20% year to date. But granted, that's after, I think, about 2-3 years of outperformance. But the market is clearly adjusting to this massive amount of supply that's hitting some of these Sun Belt markets. And we're starting to see negative rent growth already. But again, longer term, we do still like those markets, but it's going to go through a bit of an adjustment period in the next couple of years.
Yeah, so Ryan, what are you seeing since you do invest a lot in the Sun Belt?
Yeah, I mean, I still think there's a pretty compelling growth premium. We focus on growth and then affordability, and so our new mantra is really, where's the flight to affordability, instead of flight to growth. And we're looking for what is the next, Austin, Texas, the next Dallas, whether it's from a data engineering, data science perspective, or just from what we hear on the ground, or the combination of the two. And so we still believe in the Sun Belt. We still have seen, especially in the multifamily side of things, relatively stable to limited rent growth. And our view is that, again, in this mid-cap niche, there are a lot of syndicators. You hear about it on the news all the time, who came in and bought up a bunch of multi in the Sun Belt, overpaid, put in floating rate debt, and we would love to, again, be a liquidity solution to many of those folks who are looking for an exit valve in markets we believe in that are still relatively affordable. I mean, look at the spreads between renting and buying. I mean, they're the widest they've ever been. And so in multifamily, high growth, high affordability markets, Sun Belt's still where we feel pretty good long term.
He hit on the main point, is the affordability issue. That equation is as strong as ever. I mean, affordability is as bad as it's been for home ownership in 40 plus years, since the 80s. So that is the main math behind, I think, the continued demographic trend. Well, that and the winters aren't as cold in the Sun Belt.
In the Sun Belt, we like grocery-anchored retail centers. Go where the people are, just not in housing at the moment. So in Florida, we own 5 Publix grocery-anchored retail centers, anchored by a Publix grocer, and then retail that's supported around that in densely populated areas. And in Texas, if anybody's from Texas, H-E-B grocers. So we think retail is going to be kind of a sleepy underperformer, particularly in necessity retail, as a lot of bad retail has been flushed out. We've seen more store openings than closings now. So we're very much still in the Sun Belt, but for now, focused on our grocery-anchored retail.
Great. And the red light is blinking, so I think that means our time is up. And anyway, thank you very much. And thanks
Thank
everybody
you.
on our panel, too.